Well, g'day there, traders and friends right around the world. Thank you so much for joining me on this weekend market update. What I'd like to do is just speak about the price action a little bit, speak about what the Fed has done, how the markets have interpreted that information, and how we are set up to move for the upcoming week. A lot of, well, at least the markets are going to what appears to be retest old resistance, largely due to the announcement made by the Fed. Now, the Fed came out, obviously Janet Yellen made the statement Wednesday afternoon, 2 p.m., and she's really tied any future interest rate rise or tightening of the monetary policy by the Fed down to two very important economic factors. One being the continual improvement in the US labor market, and also secondly, inflationary targets of about 2%. Both are a little bit optimistic when you've got an unemployment rate at 5.5%. The initial interest rate rise was meant to come in at 6.5%, and the US economy is doing the best that it has ever done in regards to job growth, creating on average 280,000 jobs per month. Find that interesting where the Fed still hasn't increased rates, where they've gone on and said, yes, look, in the past when we hit 6.5% unemployment, this is something that we will take into consideration and probably act on. Secondly, is the inflationary targets. Now, when it comes to inflation and deflation, a lot of this is due to the appreciation in the US dollar, not only for the US markets, but also the global sort of macroeconomic picture. Not only is the US government trying to starve off deflation, a lot of the other central banks around the world and out throughout Europe for that matter, and China, are at least trying to fight off deflation. The reason why is because the US dollar again continues to appreciate in value. Now, we've seen the biggest increase in the US dollar over the past 31 years, and over the past 3 weeks when we shot out above 95.70 on the US dollar index, and we made it as high as 100 or 100 cents. You can see that this was, I think, the biggest 2-week gain since 2007, 2008. So going back about 7 to 8 years, the US dollar hadn't actually appreciated this much in that time span. What is interesting to note is that as the US dollar appreciates, inflation isn't going to be a problem. It's only when the US dollar actually deflates or loses value, loses intrinsic value, that inflation is going to be a problem. What we've seen over the past 3 days, at least, is that the US dollar has pulled back from that 100 cent level. It's pulled back down to a sort of a more reasonable level, about 97.8 US cents. And if we do see a correction in the US dollar, I think a lot of people are going to be more so surprised, or at least expect the Fed to raise rates if we see the US dollar come back down to 95 or even 92. However, in the picture of the bigger US dollar, you can see that we're still in a long-term bullish trend, and any healthy correction will be good because the overbought nature of the US dollar is just so extreme. It's been so extreme really since the beginning of 2015. It hasn't gone through any sizable retracement. If anything, it's just moved sideways. So to go out on a limb and to say that, look, the US dollar is starting to reverse its current bullish trend, I mean, you're just really making things up at this moment in time. Sure, it will be healthy if the US dollar pulls back a little bit. It may sort of, bring the debate and the question that, look, inflation may be a genuine target at 2%. But when you look at the bigger trend of the US dollar, I still think that the US government and also the Fed, the central banks, are going to, again, continue to fight the very real and true definition of deflation, deflationary pressures, again, in the US domestic markets, and also more so the global economic picture that the world is currently staring at the moment. So how does this sort of influence, the 3 US markets and, of course, our top 13 individual trade list? First of all, we have changed the compilation of our top 13 individual trade list. We have removed Twitter, we've removed Halliburton, and we've also removed Alibaba as at this current weekend's recording. What we've done is we've replaced them with Boeing Airlines. We have Chevron, which is the oil equivalent, in regards to our list for Halliburton. And also we have brought in IBM, which are 3 very nice stocks, which give us very good moves. So I've done the analysis on all 13 of these stocks. The full list is Apple, Amazon, Boeing Airlines, Baidu, Caterpillar, CVX, FAS, which is questionable given the option liquidity. We have Facebook, Google, GoPro, IBM, Netflix, and Tesla. Very good trade setups and trade management this week. When it comes to the overall market, you've got the Dow Jones Industrial Average pushing higher on the back of that Fed announcement. Obviously, the markets have interpreted that most recent Fed announcement, or lack of. I mean, sure, they did remove the word patience, but they're not necessarily impatient, and they're tying any future rate increase into 2 very questionable economic data points and largely anomalies when it comes to negative economic data. But you can see that the markets nonetheless have shrugged that off, and essentially nothing has changed, and it appears as if we are resuming the upward move to the overall resistance levels. Here we are, we've got a target on the Dow Jones at 18,250, give or take a few points. points. What we'll do is we'll monitor the daily candles at this particular moment in time. The same is true for the S&P 500. We've got levels up here about 2,120 before we start breaking out to all-time highs. But really the outlier is, of course, the NASDAQ. The NASDAQ has broken above that resistance going back to early March. Here we have a spinning top candle, nice little gap to the upside. Again, I brought it to the class. Is this an exhaustion gap or a continuation gap? We will soon find out. But I do believe that when we break it down and when we have a look at the monthly, we see just how far we have to go or how little we have to go until we have the final market hit the all-time high. What am I doing? I'm in the weekly. I need to change to a monthly. Here we go. Until we get the final market to hit the all-time high. This is going back to the year 2000 once I take off these annotations. You can see it's a long way or a long time since we've been this high. It's very realistic to expect that we are going to push on up on the NASDAQ, which is also going to influence the immediate movement in the S&P and also the Dow Jones Industrial Average. So I've got some targets up here, about 5,100. On the NASDAQ, the all-time high comes in at 5,132 points. That's also a very realistic expectation for not only the week, but maybe 2 weeks ahead. We'll gauge sentiment and, of course, the daily candles upon that move and as we push and grind higher. But it's giving us a very good framework, nonetheless, to work with. Rates may not rise. They're definitely not rising in April. Maybe June may be a little bit too premature. The expectations are maybe September, but still for me, that's largely debatable and questionable. It sets the tone that the bull market is going to continue, whether you agree with it or not, or if you believe that we are fueling further a bubble which is already in place. Again, that is up to you. That's for your own consideration. As a technical swing trader and someone who trades the minor movements in price, even the intermediate movements in price, it's just giving us some form of a momentum, some form of a direction which we can follow and base our trades off for the upcoming weeks. So some very good structures out there in the market, a vote of confidence by the market participants on Wednesday. If you're interested in learning more about the overall markets, about individual trade setups, I haven't really even dwelled or really touched down onto the sort of technical picture of a lot of these stocks. I haven't, to be fact. That's in that pro analysis class. Send me an email, success@pivotpoint-trading.com, or go on the website and have a look at the class yourself. Sign up. I'll send you an immediate email with the login credentials for you to access that class. It's recorded, it's up there online, and it's something that I think will serve you and give you a lot of value moving forward into the market each and every week. What I'll do right now, however, we are getting copped. We're getting banged by an incredibly strong and or some form of a tropical storm in Brisbane, Australia. Very torrential rain and wind outside. I've actually lost power twice during the pro recording. You'll see that. There's a part 1 and a part 2, which makes the class a little bit exciting this week. So that's all well and good. Stay safe wherever you are around the world, especially to my Australian friends in Brisbane who are copping it pretty badly at the moment. And for those of you in the United States and Northern Hemisphere, have a fantastic weekend. I look forward to bringing you additional market analysis, market updates next week. Have a great weekend. I'll see you next week. Goodbye.